The Bank of Canada has decided to hold its key interest rate steady at 2.25%, keeping the bank rate at 2.5% and the deposit rate at 2.20%. This decision comes at a difficult time for the Canadian economy, as two major forces are pulling in opposite directions. On one side, the ongoing conflict in the Middle East is pushing oil and gasoline prices higher, creating renewed inflation pressure for Canadian households. On the other side, United States tariffs are weakening exports, slowing business investment, and putting pressure on jobs in affected sectors. The central bank chose not to cut rates because lower borrowing costs could add more fuel to inflation at a time when energy prices are already rising. At the same time, it also avoided raising rates because Canada's economy remains weak after contracting in the fourth quarter of 2025 and only beginning to recover modestly in early 2026. For mortgage holders, the rate hold means variable rate mortgage payments are not expected to change immediately. Canadians with loans and lines of credit tied to prime rates will also likely see borrowing costs remain steady for now. However, fixed mortgage rates have been moving higher since January as bond yields respond to inflation concerns and global uncertainty. Inflation remains a key concern. Canada's CPI inflation rose to 2.4% in March 2026, mainly because of higher gasoline prices. The bank expects inflation to rise to around 3% in April, before easing back toward its 2% target by early 2027, assuming oil prices moderate. The labor market also remains soft. Unemployment is still in the 6.5% to 7% range, and job losses have been seen in sectors affected by United States tariffs. Weak hiring is adding pressure on workers, newcomers, and families, already facing higher living costs. The bank's latest outlook projects Canada's economy to grow by 1.2% in 2026, 1.6% in 2027, and 1.7% in 2028. Growth is expected to improve gradually, but the forecast depends heavily on what happens with oil prices, global conflict, and trade policy. The decision also affects everyday Canadians beyond mortgages. Higher gasoline and food costs are putting pressure on household budgets, while government relief measures such as the Canada Groceries and Essentials benefit and the lower federal income tax rate are intended to offset some of that strain. The Bank of Canada is now watching whether energy-driven inflation spreads more broadly into other prices. It is also monitoring the impact of United States tariffs on Canadian exports, investment, jobs, and overall economic growth. The next interest rate announcement is expected in June. For now, Canadians should not expect immediate borrowing relief, as the central bank appears focused on balancing inflation risks with signs of a slowing economy.